Hello, I'm Corey Raifstenger with the Guardian Life Insurance Company of America. In today's environment of low consumer confidence, who can you turn to these days for advice on finances, especially when it comes to life insurance? People have inarguably lost faith in those so-called experts and are turning to the most accessible free source available, the internet and television. There, financial personalities are willing to speak up in absence of anyone else, even though what they say may be extraneous, distracting, or sometimes wrong. In this next segment, in under 15 minutes, you'll hear industry consultant Dick Weber give us some straight-talk insurance advice, such as the lowest price is not always the best deal, that there are many risks in life that you simply don't know about, don't treat insurance advice like a commodity because your life is just too important, be introspective about the type of buyer you are. These aren't things that you typically hear on TV, and that's why it's worth you taking the time to watch this next segment. Dick Weber, who after a 42-year career in sales, insurance company management, and consulting within the life insurance industry, now works on behalf of consumers and their advisors, helping them better understand, purchase, and then manage their insurance policies effectively. Dick and his business partner, Chris House, recently wrote a research paper entitled Life Insurance as an Asset Class, and we've asked Dick to discuss some of its findings we felt viewers would find useful. So we're going to focus more on the process of considering what kind of buyer you are, and how best to learn about, and then potentially acquire, a complex financial asset such as life insurance. So Dick, as someone whose profession includes consumer advocacy, perhaps you can help sort through the background noise. Because of the problems in our economy, there's so much financial news and commentary these days. I know for myself it can be very confusing to sift through all that data and information, often conflicting, to try and see how it applies to me. Can you help?
Frankly, Corey, I often find myself caught in the very same dilemma. There's a vast industry devoted to the collection, dissemination, and reporting of financial data and information, and I don't think anyone can reasonably, certainly not easily, figure out what's important versus extraneous, distracting, or wrong. And yet it seems like somehow we should know or should be able to figure it out. I'm especially attentive to what I read in the press and hear on the news about life insurance because it's one of the few things about which I feel comfortable calling myself an expert. Some of what I see and hear and read is reasonably balanced and informative, but I have to say that much of it is superficial, sometimes self-serving, and sometimes just plain wrong. The classic cliche often espoused by the broader financial planning community, including the financial press, goes something like this. Life insurance is a foundation asset on which you should take the least amount of risk and pay the lowest possible premium for the least amount of time necessary while you quickly build other investment assets so that the life insurance won't be needed in the long term. Of course, we dealt with that in our earlier video on buy term and invest the difference. Most people underestimate the time frame for which they are likely to need and have transforming uses for life insurance. And we're certainly inclined to overestimate the likely real returns in the market. Obviously, in today's economy, that cliche couldn't be more wrong, but I really don't think it's ever been right. It hides an extremely dangerous financial press message that all you have to do is shop for the best deal in a life insurance policy without appreciating the unintended risks or consequences for which such a superficial purchasing scheme can be the result.
It's easy to be pulled into the cliches and oversimplify things. You've worked with a lot of consumers and you've done a lot of your own research in this area. What have you discovered and what recommendations do you have for us?
We've developed a number of observations from our perspective of relative neutrality and objectivity. And with a keen awareness of the power of cliches, here are some of our thoughts. There are many risks in life. Some can be planned for, some aren't even on the radar screen until they occur. The recent market crash and for a while our sense that we were teetering on the economic abyss is an unfortunate example for many of off-the-radar events. For those foreseen risks that can be quantified as having financial consequences, it's important to evaluate the potential cost or loss to determine whether it can be budgeted from income or savings. I like to refer to this as simple self-insurance. If the financial risk is too great to absorb, it needs to be shifted to an insurance company. And this is a classic example of the need for insurance for health, liability, disability, fire, auto, and life. Risk management can be a complex issue in today's seemingly volatile, and I guess we'd have to call it risky, financial environment. Whether we're seeking to improve net worth by, say, taking money out of insured savings and purchasing rental property, or maybe increasing the equity component of a stock portfolio, how do we address the complexity of those decisions? Many of us seek professional advice. But if we as consumers aren't committed to the process, if we don't take responsibility for understanding what risks we're taking and what outcomes that risk-taking may entail, it's very unfair to blame our advisors when the bottom falls out of the market. So financial expertise has become more and more specialized since the 1960s, when a handful of mutual funds were just becoming a popular way to invest. So has insurance expertise. When I was first introduced to the life insurance business as a senior in college in 1967, the only two options were term and whole life. And if you wanted to buy life insurance, you had to buy it from a licensed agent who typically represented just one life insurance company. Today, when information about life insurance and the purchase of a policy can be obtained with a single shopping cart click on the internet, the classic gatekeeper role of the insurance agent has dissolved, and advice, perhaps the most critical part of the relationship between client and insurance agent, has transformed into a distinct commodity by itself.
Well, I've even found myself wanting to explore my financial and retirement options on my own, but quickly realized I had gotten out of my comfort zone. Do you think that most people find themselves in that same situation?
Yeah, you're touching on something that I think has only recently begun to be realized in the financial services arena, based in part on some very important market findings by Forrester Research about consumer behavior and consumer buying styles. Forrester found that three distinct types of decision makers or buyers have emerged in the marketplace: self-directors, delegators, and validators. Self-directors are the sort of people you find at 6 a.m. on a Saturday morning waiting for Home Depot to open. They're great neighbors, especially if you have a little Tom Sawyer in you. Self-directors choose to develop their own expertise and avail themselves of the many opportunities over the internet to acquire and manage their own investment and insurance choices. Self-directors have the advantage of knowing their goals and objectives better than any advisor ever can. On the other hand, given the sheer volume of financial data, information, and misinformation that's out there, self-directors are vulnerable to the very human tendency to prefer the attractive impossibility to the less attractive probability. The attractive impossibility might be in the hope that your return on invested assets will always be positive, or the belief that your invested resources can quickly replace life insurance for the contingency of early death. The less attractive probability is the reality that it's more difficult than most people think to achieve adequate long-term returns with no risk or potholes along the way. Delegators are just the opposite. They rely on experts whose advice they value, so they themselves can direct their attention and energy in other areas. Delegators are ideal clients for financial and other professional advisors. But as we've recently seen in some rather spectacular revelations, delegators are vulnerable to dishonest or incompetent advisors. Referrals, references, and attention to personal compatibility, which I'll discuss in a minute, can be important defenses against that very small number of people who are actively out to cheat and abuse an advisory relationship. Validators, the largest of the three groups, lie between these extremes. They seek a certain amount of information on their own so they can engage more knowledgeably and actively with a professional in the process of buying life insurance or managing their portfolios. validators realize that we need to not only know what questions to ask, but to have a basis on which to understand and further evaluate the answers to those questions. In an era of financial specialization, both validators and delegators will optimize their information, advice, execution process by working with experts in the various areas of investments, insurance, real estate, accounting, estate planning, etc. Finding the right advisor while being introspective and realize what type of buyer you are is key to your life insurance buyer process. In the 25 years during which I worked with affluent clients, I realized that I worked extremely well with certain types of people, and there were some with whom I just didn't click. Since those days, we've learned to pay more attention to consumer buying style research, and we've recognized that people have very different learning styles. What we now know is that delegators and validators should attempt to find expertise from advisors with a compatible personality and what I would call worldview. In the ideal relationship, the client is explicit about expectations and the means by which he or she or they will measure success or failure. When it comes to considering the many issues involved in the purchase and management of life insurance, delegators and validators should seek out professional life insurance agents with the requisite knowledge, training, experience, licensing, and credibility. This will optimize the best possible solution for how they can use and integrate life insurance into their overall portfolios. Regardless of style, investors will be well served by what I learned at my grandmother's knee: get and stay rich the old-fashioned way, save and invest using good planning advice, patience, and diversification.
Dick, I think you've made a terrific contribution to understanding financial advice and the need in this day and age to work with specialists. That, and assessing our own buyer behavior, can help us better understand whether our process is working for us. And if not, perhaps try a different approach if the one we're using isn't giving us results that make sense in both the short and long term.
Corey, that's a great point.
Of course, each individual has their own unique circumstances that should be evaluated. But I can say with confidence that speaking with a Guardian representative will achieve the life insurance strategy that may work best for the individual. Once again, Dick, thank you for sharing your research and guidance. For more information, please ask your Guardian representative to share with you a copy of Dick and Chris's Life Insurance as an Asset Class.